So this is what I saw this morning as the London Stock Exchange opened up for trading on broad global ETFs. Yes, that is down 6% over the weekend, following up from losses that we've had in the last few days as well last week. And I don't want anybody to tell you otherwise. It hurts. It does. No matter how long you've been in the market, it hurts to see the value lost, and it sucks. I think we're probably about 20% down from the peak now within global world trackers. I use the regular MSCI World Tracker SWDA at the moment, and that one's about 20% down from the peak. So today's video is about the 5 things that you should be doing as a long-term investor to not let this market affect you. And the first one is don't panic. Panicking is the absolute worst thing that you could do at this point. There's already been losses in the market, as we've seen, and these are exactly the times that I've talked about with many friends before and in a few of the videos that I've made on this channel already, which is about you're going to expect some years there's going to be points in time where you might be down 20, 30, 40%. And the whole point of the strategy is to get you through these times and out to the other side. The problem with times like these is that with the biggest downs often comes the biggest ups as well. And so if you just sell out of panic and you're not sure if it's going to go any lower, you can end up missing out on some of the biggest days, which is where most of the recovery actually happens. I've charted out the top 20 down days and the top 20 up days on the S&P 500 since 1992. And you can see that unsurprisingly, a lot of these events are clustered together, a lot in 2008 and a lot in COVID as well around 2020. Now we can see here we've got one shining lonely star, which has made it into our top 20, which is basically the last couple of days. And so the question is, well, when are those green days going to appear? If you drop out of these investments now, you could miss out on some of these big gains. Will it go further? Maybe, but it also might not. It's very difficult to tell. And the reason why we're following this strategy in the first place is that we decided that active investing often is not the best way, and that even the best people in the market get the timing wrong. So what chance do we have of being able to do this? One of the worst parts about selling when it's down as well is you're trying to time the market twice. You're not only trying to get out at a decent time, you're also trying to get back in at a decent time too. So what you're betting on is the market's going to go even lower than it is now, despite the fact there's already been a massive move. And then you've got to try and get back in again at a lower price such that you end up saving some money between the drop periods. But that's not really that easy. If we zoom in on 2008, all of these points were either above or below 5%. And you can see the only thing that's really consistent in this period is that it is extremely volatile. It's very difficult to know when the right time is to get in and when the right time is to get out. So don't try. What's going to help with all this, rather than strategies for your investments, is going to be strategies for you personally. One of the best ways is just to not look at your account very much. It's only going to be psychologically damaging to go into your account and look and see those negative numbers, knowing what they used to be and what they are now. No matter who you are, as I said, this is going to hurt the soul when you go in there and see it, because humans don't like losses. Humans hate losses, and it's natural as part of our psychology to keep us safe from predators out in the wild. It doesn't really help when there is a stock market crash, which is not something that our biology has evolved to deal with. The important thing now is to double down on what you know. You know that this is the right strategy for the long run, especially if you're investing over 30 years, and to know that this is the right choice for you and the goals that you have over a fairly long period of time, and that really it should continue to work in the coming decades. We'll talk a little bit about that more in detail right at the end. So point number 3 is about the strategy itself. You may well be able to sit back and think, okay, this is the right strategy for me and I'm going to carry on and this is fine. But for a lot of people, they tend to find these periods are periods of reflection where they look at what they're doing and they think, really, is this exactly what I need to be doing? Now, the first port of call, partly with don't panic, is that you shouldn't be making any strategy changes right now. Honestly, it's too late for that, and any strategy changes should have happened beforehand. But once things stabilize and even out and the market isn't so volatile, then it's definitely something that you can think about. A lot of people might easily think, oh, well, I wish I was in bonds at the moment. But when you look back at the previous crisis, 2022, and I know it's under different circumstances, we saw that bonds fell along with stocks. So it's not always necessarily obvious what you should have done before the crisis has actually appeared. One interesting thing about this crash at the moment for international investors is that usually we've actually been pretty defended from moves in the stock market because of our own currencies. If you look at the Great British Pound, for example, normally what happens is when things get sticky in the market drops and there's fear and there's a reason for that fear, and usually people flood into safe haven assets like the dollar. And what that does to local currencies is that drives the dollar up and it drives the local currencies down. But interestingly, what that does is it revalues assets outside of our own local currency higher, because when we convert that back into pounds, for example, if the dollar has got stronger, we actually end up with more pounds. So even if you get a sell-off of 3%, for example, if our own currency goes down by 2, the difference is only 1%. This has led to a lot of international indices actually being less volatile in an international investor's own currency than it has been in US dollars. Kind of strange, but we've been a bit protected by this. The problem that we've got right now is that it's because it's America that's actually the problem. We've found that our local currencies have strengthened too, which has the opposite effect. Not only are stocks going down, but our currency is also going up, which means that the US stocks are being revalued into our currency and are actually worth less than they were before. This has a double whammy effect and is one of the reasons why international investors are feeling the pinch quite so strongly. So this has led me to wonder whether I should look at the currency hedged version of the ETFs. I'm not going to do it now, but I want this tool in my back pocket such that if our local currency does fall again against the dollar in the future, that if it gets to a low level, I could potentially swap over into those ETFs so that I'm then not hurt by it when our currency goes back up again. So one to think about for the future, but right now is not the time to be putting in place these changes through the volatility that we're seeing. So this brings us to number 4, which is that we're deciding to stay the course. We're keeping our strategy. We're doing exactly what we were doing. And this involves everything around trying not to time the market and looking at dollar cost averaging, which is what we probably were doing anyway if we were monthly investing into the market. The beauty about continuing to dollar cost average is that although it may feel a bit scary and that things might go further, is that you are getting a much cheaper price than you would have been last month. If 1 month ago, stock market had just stayed where it was, you probably would have been happy to invest in it. But now that it's 20% down, everybody gets all scared all of a sudden. Yes, things may seem like they've changed, but you're actually getting a discounted price for the future for the long-term investment goals that we have. With dollar cost averaging, it's almost the best of both worlds. We're getting a cheaper price right now, and then if things carry on going down in the next month, then we're going to get them cheaper again still. And this is the beauty of it. You buy less in terms of shares as the market goes up, and you buy more in terms of shares as the market goes down. This is going to help you when things do eventually recover, and I really do think that they will. But over what time horizon, it's very, very uncertain. So just keep dripping into the market, and you should be able to come out okay once we're on the other side of it, which again, I think we will be at some point. It's useful to think of the story of the worst investor ever, where they managed to invest at the peak of the market every single year. And although they immediately lose money after every single investment, after 20 years, they still end up coming out making multiple times of their initial investments, typically because the market is just much stronger over the long term than you ever end up losing in these short-term crashes. Most of the time, even if you invest at a point that's very bad, by the time that the next crash comes, you're already a lot higher than where you were previously, so in the long run, it ends up not mattering actually that much, or as much as you might think anyway. But where do I get this confidence that things will be okay in 5-10 years' time anyway? Well, this is the human condition that we always think that this time is different. Every time we have a crisis, we always think that it's different. COVID, 2008, 2002, all of these things feel terrible at the time, and it feels like the world is ending for one reason or another. Global population might be wiped out by a rapidly changing virus that's going to change. We're never going to be able to beat it. The whole banking system is falling apart, and the actual fundamental underpinnings of our system are collapsing, which is how we actually exchange our financial transactions in the first place. All of the new tech companies are blowing apart, and value is just being destroyed all over the place. All of these things feel very existential at the time, but people have a way of working through, and companies and governments also usually have a way of working through these things. We are probably one of the biggest weaknesses of the buy and hold, dollar cost averaging, long-term ETF type strategy, in that we're psychological beings, and ultimately we hate sitting there doing nothing, even if that's the best option. What helps me, rather than actually fiddling with my portfolio or trying to time the market or anything, is just to understand what is going on. That helps me to bring back some level of control over my investments and try to understand exactly what is happening so that I can broadly understand the moves, even if I'm not necessarily acting on them per se. I watched this amazing video a couple of days ago from Macro and Money, which really helped me kind of understand the US administration's point of view. And while I might not agree with the policies they're putting in place, I can at least get inside their heads and understand why they might want to do this, rather than it just looking like insanity from the outside. If you're interested in this stuff and want to kind of understand from a non-biased perspective why these things might be happening, I do implore you to go and look at that video, because it really helped me solidify what I was thinking about already. But from my perspective, what it seems to be is about manufacturing. It's the undercurrent that they're not saying out loud is about manufacturing coming back to the United States for the purposes of war, if that does happen with a country like China. That is where I think that the big worry is, because oftentimes in war, what happens is your manufacturing base is the one that is being used for regular civilian purposes, and those get swapped over to producing arms, bullets, or whatever it might be for a war economy. And the problem is that if you've gutted out your manufacturing enterprises and it's somewhere else and they're making the stuff for you, there's kind of a supply chain problem there, just in case you end up having a war with, say, the partner who's making all of the stuff. Now, there's probably better ways of going about this, in my opinion, but I believe that this is what the administration is trying to solve. It's a national security problem for them, which is why they don't really care about the stock market doing what it's doing. Also, the stock market disproportionately hurts the wealthy, and their voter base is predominantly not of that demographic. Not all of them, obviously, but they have a very wide demographic within the old manufacturing zones that would benefit from policies such as this, at the expense of the greater economy. Ultimately, I personally believe that the tariff situation will get fixed with the Western developed economies, such as the United Kingdom, because we don't really pose a threat in this way. We're broadly allies. We don't really make much stuff ourselves anyway. We're also in the same situation, buying things in from countries such as China, South Korea, and the other places that run large trade surpluses. So I do think that within the westernized countries that this will end up getting solved. However, I do think that it's probably going to be a big barrier to China and other places like that for quite a while, those countries that the United States perceives as a threat. This is going to be very disruptive to stocks for a little bit at least, and how long that's going to take to recover, I don't really know. But ultimately, I think it's going to be okay. Do we think that Nvidia is going to stop selling AI chips just because of all of this trade disruption? In the short term, maybe. In the long run, probably not. I think these companies are still going to be very valuable, they're still doing cutting edge work, and the world is still benefiting from them. So irrespective of the politics, in the long run, I still think the strategy is going to be okay. I like to think about this compared to 2008 because that one did really feel like the end of the world. And in comparison to that, this is a changing world for sure, but it's not necessarily as disruptive as all of the banks collapsing might have been. So for the sake of all of us, I do hope I'm right, and I hope that I've managed to alleviate your fears a little bit around what we should be doing in these times of crisis. Stay the course, stay strong, don't let it affect your psychology too much, just try to get on with your day to day, and then think about strategy changes in the long run afterwards.